If you follow finance, you know the drill. Earnings reports, central bank policy, GDP figures. The usual suspects.
Right. Those are the foundations of conventional analysis. Solid stuff.
But today, we are kind of throwing out the textbook. We're looking at something truly bizarre.
Bizarre is a good word for it.
We're asking, can the fundamental cycles of the sun and the moon actually predict things? Like everything from multi-decade economic growth down to your daily stock market returns.
It sounds pretty out there, I know.
Okay, let's unpack this because, wow, the sheer scope of the sources we're wading through today is incredible.
It really is.
We're drawing on over a century of economic thought, starting way back, like 19th century theories linking sunspots to crop prices.
All the way up to modern quantitative analysts. Really detailed studies correlating lunar phases with global stock indexes over the last 100 years even.
So what's fascinating here, I think, is that we aren't just looking at fringe theories, are we?
No, not entirely. We are actually seeking coherence, trying to see if there's a connection across disciplines that usually stay separate.
Yeah.
Fundamentals, technical analysis.
And even that shadowy world of astro trading.
Exactly. The hypothesis that kind of emerges from all this material is that maybe solar and lunar phenomena are the underlying natural driver for many of the cyclical patterns we already see.
Patterns in human behavior.
Yeah.
And in the markets.
Yes. That's the core idea bubbling up.
That's a staggering assertion for modern economics, though. So our mission today is to see if these cycles are, statistically significant enough to actually matter to you listening right now.
Right. Do they hold up?
We're starting big, tackling the enormous long-term 11-year solar cycles first. Those seem to affect the macro trends.
And then we'll zoom right in, down to the monthly lunar rhythms that seem to affect our minute-to-minute trading behavior.
Okay, let's start there, the long view.
We have to start with the original sunspot theory. This foundational idea came from William Stanley Jevons back in 1875.
Wow, that's going way back.
It is. And his son, H.S. Jevons, continued the work later on.
And their theory was rooted entirely in the physical world, wasn't it? Linking solar physics directly to agriculture.
Pretty much.
Yeah.
It was a simple chain reaction, really potent for the pre-industrial economy. Jevons theorized that cyclical solar activity, you measure it by sunspots.
Right. More sunspots, more activity.
Exactly. That created changes in weather, climate. And those climatic shifts directly affected agricultural output, farm income.
Okay, makes sense for that era.
And then fluctuations in crop production would cascade, right? They impact supporting industries, the forward and backward linkages.
So everything connected to farming.
Ultimately determining the overall pace of economic activity, generating those business cycles everyone was trying to figure out.
But it sounds like a theory that should have faded away once the global economy industrialized, right? I mean, agriculture just isn't the dominant force it used to be in GDP.
Well, it's true that its direct mechanism is less relevant today, globally speaking. However, the source material does note this theory remains particularly powerful even now for certain regions.
Oh, really?
Where? Arid and semi-arid areas. Places where small climatic changes have these massively exaggerated effects on farm output. Think droughts, floods.
Ah, okay. So it still has pockets of relevance.
Definitely.
Yeah.
And it's worth noting, Jevons wasn't alone back then. Contemporaries like H.L. Moore proposed similar nature theories. He tried linking Venus's behavior to rainfall cycles and business activity.
Venus. Okay, that's even more out there. But sticking with the sun, if we move past crops, how does this 11-year cycle, this huge force of solar physics, how does it jump the enormous conceptual gap to directly influence human risk-taking? Human psychology.
That is the core question, isn't it? And to bridge that gap, we need to shift gears and look at the work of Alexander Chejevsky. This was around 1924. He did something remarkable. He compared detailed sunspot records to major historical events. Everything from migration waves to revolutions.
Across the globe.
Across 72 countries, over 2 millennia. It was a massive undertaking.
Wow. And what did he find?
He found a consistent concentration of human activity. Big disruptive activity clustering around the solar maximums, the peaks of the sunspot cycle.
Okay, so how does he make that leap? From plasma physics, essentially, to predicting political revolutions. What's the mechanism?
He theorized that solar maximums increase something he called mass human excitability.
Mass human excitability.
Yeah. The idea is that high solar activity somehow translates to increased neurological energy, makes populations more restless, more organized, more willing to take risks. Big risks, both political and financial.
Huh. So he actually broke down the 11-year cycle based on this excitability?
He did, into 4 distinct periods. First, you get about 3 years of minimum activity. This is a time of passivity, stability, maybe even autocratic rule. Things are quiet.
Got it. Low energy.
Then comes a 2-year period of organization. This is where masses start gathering under new leaders, new ideas gain traction, people start mobilizing.
Okay, things are starting to stir.
Next up, the peak. 3 years of maximum excitability. And this is where Chayefsky's data showed direct correlations with revolutions, wars, periods of intense conflict, maximum energy, maximum disruption.
Right when the sun is most active.
Exactly. And finally, you have about 3 years where excitability gradually decreases, things calm down until apathy sets in again, ready for the next minimum.
That's a wild framework.
Right.
It suggests huge social instability is somehow physically linked to what the sun is doing. So if this holds, how does that excitability translate directly into financial markets, into buying and selling?
It connects through risk appetite. Simple as that. The 4-year period leading from the solar minimum, when activity is rising, up to the solar maximum.
When excitability is building.
Precisely. That period is consistently one of strong stock market gains, because that growing excitability fuels rising risk-taking. People feel bolder, more optimistic.
And when we actually look back historically, do the numbers support that?
They're pretty hard to ignore, actually.
Yeah.
Historical data for the Dow Jones Industrials, for example, shows an average 70% return gain just for that 4-year window between the solar minimum and the solar maximum.
70% average gain in 4 years, tied to the solar cycle.
Yeah. It strongly suggests that collective human mania, maybe driven by the celestial clock, is directly responsible for these long periods of asset appreciation.
Wow. Okay.
And this collective risk-taking seems to culminate right around the solar maximum. You know those big secular bull market peaks?
Really long ones, like 10, 20 years.
Those decade-long swings between hard assets and paper assets. They consistently fall close to solar cycle maximums. Maximum excitability seems to drive maximum speculation, maximum peaks.
So the collective global mood gets manic, driving risk assets sky high right into that solar peak. What happens next when the enthusiasm, inevitably deflates?
Well, first, that manic enthusiasm correlates with macro factors. Peaks in U.S. inflation, for instance, consistently correspond to solar maximum.
Okay, inflation peaks with the sun's peak.
And troughs in inflation correspond to solar minimums. So the economy often experiences growthflation. You get both inflation and growth accelerating together, leading into those solar peaks.
Growth and inflation rising together until
the recession hits. Recessions typically follow the solar peak.
Ah, okay. So the downturn comes after the peak excitability.
Yes, and interestingly, the timing often corresponds to the peak in geomagnetism. That's the Earth's magnetic field activity. It often lags the solar maximum itself.
So the sun calms down, but Earth's magnetic field is still reactive.
Exactly. And while solar activity declines, some researchers think the resulting geomagnetic instability might actually increase psychological stress, anxiety, apathy.
Providing the perfect conditions for growth to shrink and investors to suddenly get risk-averse.
That seems to be the theory connecting the post-peak downturn.
Okay, before we move on to the shorter cycles, we have to touch on something you mentioned earlier. This idea relates to a classic market timing tool, the decennial cycle.
Ah, yes. The decennial pattern.
That's the popular belief, right? That years ending in certain digits are predictive. Like, years ending in 0 are supposed to be bad, years ending in 5 are great.
Exactly. And the source material we looked at argues the decennial cycle is a perfect example of correlation maybe masking the real cause.
How so?
It might simply be a temporary statistical fluke, just a reflection of how solar cycles happen to align with our calendar over the last 130 years or so.
So it's not the year ending in 5 that's inherently good?
Probably not. Historically, years ending in 5 just happen to fall within that bullish period. Solar minimum rising to solar maximum much more frequently than years ending in 0, which often fell in less favorable parts of the solar cycle.
I see. So if solar activity is the real underlying driver of mood and risk,
then the 10-year market cycle is just an arbitrary pattern, a kind of red herring that you'd expect to break down eventually, making it a pretty misleading tool for prediction if you rely on it alone.
That's a fantastic piece of context. Okay, let's ditch the decade-long cycles then. Let's transition to something much quicker. The monthly lunar cycle, just 29.5 days. How does that affect daily trading?
Right, so the mechanism here shifts completely. We're moving away from electromagnetism and macro trends.
And focusing on what? Moonlight?
Pretty much. Nocturnal illumination and behavioral psychology. The phase of the moon determines how much light there is at night, and historically that affected everything. Hunting patterns, animal behavior, human sleep cycles.
Okay, but the hypothesis is that even with modern electricity everywhere, we're still somehow biologically hardwired to respond to those phases, even subconsciously.
Precisely. That's the core idea. The theory specifically posits that the full moon, maximum brightness, might be associated with increased depression, pessimism, or maybe anxiety.
Why? Any ideas?
Well, speculation includes historical reasons, like maybe tension around nocturnal predators being more active, or maybe it's just compromised sleep from the brighter light affecting mood.
Right, poor sleep makes anyone grumpy.
And this anxiety, this mood shift, is thought to influence investor sentiment, risk-taking behavior in the markets on a day-to-day basis.
Okay, this is where the empirical data gets, frankly, shocking. Based on that landmark Ditchev and Jain study from 2001, what did they actually find about stock returns and the phase of the moon?
They found really strong, globally pervasive lunar cycle effects in stock returns. It was quite stunning.
Going how?
Get this. Returns in the 15 days around the new moon, the dark phase, which we might associate with quiet, maybe optimism, renewal.
Okay.
Those returns are about double the returns in the 15 days around the full moon. The bright phase, associated with that potential tension and pessimism.
Wait, double the returns, just based on the moon phase. The sheer economic magnitude of that difference over just a 29.5-day cycle, that's immense.
It is. And the pattern held up remarkably well. They found it in all major U.S. indexes over 100 years.
A century of data.
Yes, and in nearly all stock indexes of 24 other countries they looked at across 3 decades. It was a global phenomenon.
Wow, so the annualized difference must be huge then.
It is. It ranges from 5% to 10% annualized difference between new moon periods and full moon periods. That rivals the entire market risk premium itself.
Just to put numbers on it.
If you look specifically at the G7 countries in their study, the annualized new moon returns average 13.18%. Compare that to just 4.82% for the full moon returns.
13% versus less than 5%. That's staggering. It suggests the new moon brings out collective optimism and buying, pushing prices up.
While the full moon generates anxiety, maybe encourages selling or just a lack of buying, resulting in those depressed returns. That's the pattern the data showed, yes.
No, there has to be a catch, right? Or everyone would trade this.
Well, we have to acknowledge the critical perspective. Always. While that historical data is incredibly compelling, not all studies confirm this level of statistical significance today.
Ah, okay. So more recent data is less clear.
A bit. One recent statistical investigation, looking specifically at U.S. data from 2012 to 2022, found that while mean returns and volatility did vary slightly across the lunar phases,
they weren't statistically significant.
Exactly. In that specific study, the differences didn't meet the threshold for statistical significance. However, even that study noted some subtle psychological shifts.
Like what?
They observed that risk aversion appeared slightly lower during the full moon, and it seemed to increase a bit during the waning phases. So even if it wasn't impacting average returns significantly in that decade, it hints that subtle psychological shifts might still be occurring.
Okay, so that definitely makes the data muddy. You're forced to choose between that really strong long-term historical average and the less conclusive recent decade. Interesting.
It definitely complicates the picture.
Let's pivot now. Let's move from the astronomical lunar cycle, the physical influence of the moon's light, to the cultural lunar calendar. Specifically, the Lunar New Year effect found in many East Asian markets.
Right, this is an interesting shift because we're moving from a potential geophysical or biological influence to something that's clearly a cultural and calendar-driven anomaly.
Okay, and what do studies show there, say in markets like Vietnam's Ho Chi Minh Stock Exchange?
Studies focusing on markets like Ho Chi Minh confirm a really significant and highly predictable surge in returns, specifically in the days leading up to the Lunar New Year, or LNY.
A pre-holiday surge. Is this driven by cosmic cycles again, or is it something more grounded, like just cold, hard cash?
It appears to be largely driven by cultural and behavioral factors tied directly to the holiday itself, not the moon phase per se.
Okay, explain that.
Well, the Lunar New Year across many Asian cultures is universally associated with optimism, renewal, prosperity, good fortune.
A very positive time, culturally.
Absolutely. And this massive shift in collective mood seems to naturally lead to increased buying activity, more speculative trading, especially by individual investors feeling hopeful.
And you mentioned cash.
Critically, yes. There's a strong financial factor, too. Many companies issue large employee bonuses right before the LNY holiday.
Ah, so there's an influx of cash into people's pockets.
Exactly. Fresh capital hitting the market, fueled by all that holiday optimism. It creates buying pressure and drives prices up just before the break.
Okay, and this leads to a crucial distinction, you said, from the general new moon, full moon cycle we just discussed.
Absolutely. The LNY surge is very clearly front-loaded. The studies confirm that while the surge exists, often significantly, in the last few trading days before the holiday.
The buying happens beforehand.
Yes. But the average returns in the days following the Lunar New Year, after markets reopen, are generally not significantly higher than average market returns on other days.
So the optimism, the cash, the buying, it all gets priced in before the cultural event even begins.
It seems so. The effect is concentrated in the anticipation phase.
Fascinating. Okay, so wrapping this all up, what does this all mean? We've covered everything from, 19th century theories linking sunspots to climate-driven recessions.
All the way to global data showing monthly lunar phases potentially doubling your stock returns, depending on the study period.
It's a wild ride. What are the big takeaways?
I think there are two major takeaways emerging from this material. First, we have pretty compelling evidence, especially historically, that both long-term, like the 11-year solar cycle, and short-term, the 29.5-day lunar cycle. These natural rhythms consistently seem to synchronize with collective human moods.
Moods that then drive markets.
Exactly. Moods that, in turn, drive major market trends and even daily price fluctuations. The sun and moon don't trade stocks, obviously.
But they absolutely seem to influence the traders who do.
Precisely. And whether that connection is, direct deterministic causality like solar flares actually altering our nervous systems, which some research explores, or if it's purely a psychological resonance, a deep-seated response to natural rhythms.
Either way, the pattern seems to be there.
Either way, these celestial patterns appear to offer a robust framework for understanding the ebb and flow of collective human energy, of sentiment. The sheer consistency of these cycles over such long time periods strongly suggests that solar and lunar phenomena might be key generators.
Generators of what?
Of many established market cycles that traditional finance observes, but often struggles to fully explain. Things like sentiment waves, seasonal patterns. Maybe their roots lie partly in these natural cycles.
Okay. And finally, let's leave our listeners with that provocative thought you mentioned, something to chew on.
Right. It challenges the foundations of purely rational financial models. Consider the 11-year cycle. The evidence for its impact on the U.S. economy persists even when you completely discount the original Jevons sunspot to agriculture theory for the modern world.
So, if there isn't direct causality between solar cycles and today's complex economic activity, what else is going on?
Exactly. What other major phenomena occur with such regularity, roughly every 11 years, that just happen to coincide so neatly with economic expansions and recessions? If it's not the sun directly causing it anymore, what is it?
A huge, unanswered question.
And consider the lunar findings, too. If the historical difference between new moon and full moon returns globally is potentially so stark that it rivals the market risk premium itself, why hasn't that anomaly been completely arbitraged away? Why isn't it fully priced out of the markets by sophisticated, rational traders, especially if the effect persists even subtly today?
Makes you wonder just how rational the market truly is.
It certainly does.